This is part 1, and it covers additional inventory issues, valuing inventory at lower of cost or market, and using the gross profit method. Now, subsequent measurements of inventory. What happens is, well, things happen. Inventory is damaged, it physically deteriorates, it becomes obsolete, or there is a change in the price, which reduced the ability to sell. GAAP requires that companies evaluate their unsold inventory at the end of each reporting period. Now we have two approaches. One is called the lower of cost or net realizable value. That's the easy one to do. And all you're going to do is compare the cost to net realizable value, which is going to be the cost minus the sales commission. And whichever's lower is what you're going to use to value the inventory. The other one is the lower of cost or market. This one is a little different because it's got ranges, and it's used specifically for LIFO or retail inventory methods. So if you're not using LIFO and you're not using the retail inventory methods, then you can use the lower of cost or net realizable value, which is the easy one. So let's take a look at the lower of cost or net realizable value. Now again, net realizable value is the estimated selling price of an item less the cost to sell it, including the transportation. So in our example, what we're going to do is for product 101, we're going to compare the cost, what we paid for it, of $120, and currently its net realizable value is $100,000. So that means that's the amount we have to value it for in inventory. Product 102 costs $90, net realizable value is $110, so we're going to stick with the cost on that one. Product 103, the net realizable value is lower, so that's the number we're going to use. And for product 104, the cost is lower, so that's what we're going to use. Now, what we're going to do is we're going to add that up. And it turns out if we do it by product line, we're going to have to write down our inventory. The difference between the cost and the inventory value is going to be, we're going to have to write it down by 30,000. So the journal entry, if done by product, would be $30,000 increase in cost of goods sold and a reduction in inventory of 30,000. Now another way you can apply this method is by just taking our total cost and comparing it to the total value of the inventory based on this comparison. And in that case, if we were to do that, since net realizable value is higher, we would do no journal entry. So that's the difference between those two. And remember, for net realizable value, you can do it by line item, you can do it by product category, or you can do it by total inventory. Now we're going to look at the other method. Lower of cost or market. Again, this is used when you have LIFO or retail methods. So what we do when we use this method is before we can come up with market, we have to first calculate the ceiling, which is the sales price minus disposal costs. And then we're going to create a floor, which is the net realizable value, sales price minus disposal cost, and additionally, we're going to take off the profit. Now, here is an example of what we're talking about. So, we have a ceiling, that's net realizable value, and we have a floor, which is net realizable value less normal profit. What we're saying, the replacement cost must fall within that range, or if the replacement cost is higher, we have to use the ceiling, and if the replacement cost is lower, we have to use the floor. So let's take a look at an example. So here we have an example. We have the unit cost, we have replacement cost, we have estimated selling price, and then the cost for disposal and normal profit for each one of our products. So, for instance, we know that the replacement cost is $840. So to come up with a ceiling, we're going to take our 1050 and we're going to subtract our cost of disposal. And that tells us our ceiling is $9, which means that the 840, which is less than the ceiling, so that means so far the 840 is okay. Now we're going to calculate the floor. We're going to take that $9, which is the net realizable value, minus the profit. And that gives us $720. Now, since the 840 falls within the range, we would use our replacement cost. Now we'll go through and look at each item, and this is how I work the problem. So here's the item, the selling price. I'm going to subtract out the disposal cost, and that's going to give me my ceiling or net realizable value. Now what I'm going to do is subtract out the profit, and that gives me my floor. Now I'm going to compare it to the designated market. So for A, I know that the 840 falls within the range of the $9 and $720, so that's the number I'm going to use to compare to cost. The next one, the $790, also falls within the range. So I would use the $790. Now the $540 is below the floor of $545, so we have to use the $545. Now the $420 falls within the range, so we would be able to use that. And then the last, the $630, is higher than the ceiling, so we have to use the $6. Now we have the numbers, the designated market, that we're going to use to compare to the actual cost associated with our inventory. So here is the designated market, and we're going to compare it to the cost, and we're going to select whichever is lower. So in the first case, we're going to stick with our cost of $750. In the next case, we're going to go with the designated market. And for C, we're going to go with the designated market. For D, we're going to go with the 380. And for E, we're going to go with the designated market. Now we're going to take that and subtract our cost. And now we're going to get the amount that we have to write down the individual items. We're going to take it times the units, and we're going to total that up, and it tells us we're going to have to write $950 off. So there's two ways that, well, you can look at that for a few minutes so you can see what that's all about. Now, there are two ways to write off the loss. The first is the cost of goods sale method. We're going to debit cost of goods sold for the loss and do not show as a separate line item on the income statement. Or we're going to, if, only if, the loss is substantial and unusual, we would treat it as an expense called loss on decline in inventory, and we would show it as part of other. So here are the two journal entries. The first, not unusual, it's going to increase cost of goods sold, decrease inventory. If it is unusual and substantial, it has to be both of those, it would be a line item in other, but we'd still just reduce our inventory. Now here's a comparison between GAAP and the international standard. Under GAAP, we cannot reverse any write-downs. But under the IRS, under certain circumstances, we can. Now, under GAAP, we can apply to individual items, inventory categories, or the entire inventory. Under the international standard, they really want it applied to individual items. Under certain circumstances, they'll allow you to do categories, but they really want you to do it to items, which personally I think is the best way. Now the last thing we're going to cover in part 1 is the gross profit method. This is used to estimate inventory when you're using periodic and you don't have time to do a physical inventory and it's between reporting periods. You cannot use this for financial reporting purposes, but you can use it during the month, especially if you've had a fire. So gross profit method, also known as the gross margin, is useful in situations where estimates are desirable. Say you had a fire or a loss or things were stolen. In estimating inventory and cost of goods sold for interim reporting, avoiding the expense of a physical inventory, but you still have to do it quarterly. And again, this is if you use periodic. In auditors' testing of the overall reasonableness of inventory amounts reported by clients, they may use it, and in budgeting. So here's the difference. Usually how you calculate cost of goods sold, you take beginning inventory plus purchases minus ending inventory, and you get cost of goods sold. But when you use the gross profit method, what you're doing, you're starting with beginning inventory plus purchases, gives you cost of goods available for sale. You're going to estimate cost of goods sold to get estimated ending inventory. Now, one more thing before we do an example. Sometimes in the problem, they're going to give you gross profit on cost instead of on sales. So this is the conversion to do that. You're going to take the percentage markup on costs and take 100% plus the percentage markup on costs, and that will give you gross profit on sales. So here's an example. If you were given 25% gross profit on costs, it's the same as 20% gross profit on sales. So now let's do an example. But first, let's look at the formula. If you just write down the formula and just plug in the numbers, you'll get exactly the correct answer. So you always start with beginning inventory plus purchases minus purchase returns minus purchase discounts plus freight in. Remember, this is periodic because that's the only time you'd have these accounts. Total cost of goods available for sale less estimated inventory, which is net sales minus sales times gross profit, gives you estimated ending inventory. So now let's work an example. Okay, you had a fire destroy your inventory. You had beginning inventory of 1.9. You had net purchases of 5.8. You had freight in of 400,000, and sales were 8.2 million. Your gross profit is estimated at 20%. Beginning inventory plus net purchases plus freight in tells you your total cost of goods available for sale is $8,100,000. Less cost of goods sold. You had net sales minus gross profit, which is 8.2 million times 20%. Gives you estimated cost of goods sold of $6,560,000. That gives you your estimated ending inventory of $1,540,000. So you would journal, well, if you're doing interim reporting, this you would use for insurance purposes. But again, you cannot use this method for reporting purposes. And that ends part